Ladies and gentlemen, good afternoon. I have the happy task of waking you up from lunch. um, right. An important notice at first, not to take for granted what I say. Do your research, please. We are obliged always to give you this qualification. But just a few words about who we are. We are a resources-focused investment management firm, which I launched in 2004. And the principle behind our positioning was that we believed in the super cycle for energy and commodities. It was early days of the Chinese miracle developing, and we thought that the combination of China and India alone, with their 2.5 billion of populace, could drive a massive demand for energy and commodities. So we decided that one of the best ways to take advantage of that cycle would be to focus in companies that explored and found oil and brought it to the market efficiently. And moreover, we decided to focus in the less researched, smaller capitalization companies, emerging companies that were not very well known in the marketplace, whilst at the same time trying to limit any incidental risk, primarily political risk, so no Russia, CIS exposure, none of the more risky, more volatile African nations, and focus on proven production and reserve growth. So it's a fundamental value-driven long-only strategy with high conviction portfolios and no leverage. And thinking about our positioning and our thesis of a super cycle, we were thinking back that super cycles typically last anything between 30 and 50 years in history. And this one was going to be no exception and be a very, very long cycle lasting higher for longer. Now, obviously, with hindsight, we were right about the growth in demand coming out of China and India and other emerging countries. We were right about the relative constraint of supply, given that there have been no major finds of oil reserves identified in the world, and also that the cost of production rose significantly, therefore pushing the price of the commodity higher. Where, with hindsight, where we were wrong, or what we failed to anticipate, was the remarkable transformation brought on by the shale industry and the inventiveness of the engineers who discovered how to best exploit those reserves, and the massive supply that hit the market was evidenced in 2014 in an oversupplied market and caused this significant price collapse that you see on the chart. Nevertheless, we still believe that the solution for low oil prices is low oil prices, and the market has started reasserting itself. And we see it nowadays with data coming out primarily from the US of significant draws from the stockpiles and a gradual stabilization of the supply-demand balance. So it is very likely that just as we saw the super spike in oil prices in 2008, reaching up to $147 a barrel, we saw the nadir in early 2016 reaching about 26 a barrel. And we are now on an uptrend, hopefully stabilizing to some more reasonable levels that mean better economics for most oil companies. So if we look at most reasonable forecasts, we have found one that bears a lot of credibility, given that it's been compiled by data provided by BP, the Energy Information Administration of the US, and the International Energy Agency, all combined by the team of analysts at HSBC. And the interesting thing that this forecast presents is that the US light oil, meaning the shale plays, will continue to be a dominant supplier of crude oil to the world market well into 2020. And it's going to take market share effectively from other producing basins. And we believe that makes us think that not only OPEC has managed to stabilize the supply-demand situation with their quotas, but they have also indicated the problem that lies elsewhere, that the fundamental supply from global producing regions is actually declining. So yes, the North American more elastic shale oil plays might be contributing to the supply of oil, growing production back up, but they do not mask the underlying problem, which is the fundamental supply decline from elsewhere in the world. Now, how does that play back, or how has that played back into the E&P companies? You can see here a very interesting chart that we have identified recently that shows the relative performance of the energy index. It's a global energy index versus the S&P 500. And you can see from this chart that since the highs back in 2008, before the financial crisis that is, and the euphoria caused by the spike in oil prices to $147 a barrel, there has been a continuing decline in relative performance by the energy index, as investors have been disappointed time and time again, particularly after the oil price collapse in 2014, by the poor earnings visibility of the energy sector, and have focused on other industrial or technology sectors. Now, where is this going to end? No one knows. Obviously, that chart indicates that the current underperformance has been much longer than the previous long-term underperformance, now reaching 9.5 years, as this chart was put together in August this year. But it does give us a feel that we may be nearing somewhere towards the bottom. Another interesting chart, which is not dissimilar, is the market cap of the energy sector as a whole as a percentage of the entire market. And that again shows how the energy sector has fallen out of favor with investors, and again is reaching lows that we haven't seen for a very long time, almost since the turn of the century, which was the previous oil crisis, with oil selling at $10 a barrel. So where are we now? We believe that things might be changing. A little bit of a focus in the last few months indicates that as the oil prices recover, the speculators seems to be jumping on the bandwagon. You see here the speculative activity, and that means hedge funds and other specialist investors that trade the oil futures, that show that there has been an increased activity, particularly since the middle of this year, in the last few months, with people betting on an oil price rise. So people are still focusing on the commodity. They believe that, at least as far as these figures are concerned, believe that the supply-demand is being restored, the balance. Stockpiles are getting drawn down, and at some point, we may get into a situation where supply is short again to demand. Data coming out of very reputable sources, such as the International Energy Agency, indicate that global demand continues to grow, with China taking the majority of that growth in demand. And as I showed earlier in the forecast, some people believe that we may end up with an undersupply situation with a shortfall of up to 1.5 million barrels a day by 2020. So we all know what an undersupplied market does to prices. Prices tend to go significantly higher. So I think no one is going to be bold yet to forecast oil prices returning to $100 a barrel. But we may get to the situation where 60 or 70 appears to be a reasonable price, and companies are starting to budget on that basis. So if we accept, therefore, that we may be turning a corner and there is a better outlook ahead for the oil prices, how do we position our investments? Now, we believe that the market is still very sore from the massive losses inflicted on investors as a result of the catastrophic collapse of oil prices. So we believe that we still need to be prudent and steer away from blue sky exploration or very sort of marginal projects that promise huge return potential, but yet the underlying risk is significant. There is a lot of indebtedness still borne by the industry. One has to be very careful about the liquidity, about the balance sheet strength, and most importantly, the ability of the company to deliver the growth that they promise, i.e. something that has a good netback, that is financeable, and that is able to sustain the operations in case we have another dip down in oil prices. We also think that the small capitalization companies have suffered disproportionately in the sell-off. You see, for example, I was amazed to see the other day that the price of Shell has reached the highs it was trading at before the oil price collapse. And it is astonishing to see that investors are putting so much faith in an integrated oil company that has a negative reserves growth. They sell more oil than they actually discover. So the reserve replenishment ratio is negative. And the obvious answer to that might be that investors are still hunting for yield. We are in a low yield environment. People see the 4 or 5% promised by Shell, and therefore like the story. They like to have a return, a cash return on the investment, as well as the exposure in the oil prices. But as is usually the case, historically, people invest in the large caps. Safety is the name of the game when times are fraught, when times are risky. And then gradually, as these companies become fairly valued, if not overvalued, people look at the next tier of valuation, which are the mid caps and the small caps that offer better fundamental value. So we still like to have some exploration exposure, but not disproportionate to the production picture and the actual reserves commanded by the company. To show you the positioning of our fund and how we approach our investments, and another case in point is that our Junior Oil Trust, which is a small cap focused fund, has started outperforming its peer group for the last 12 months, and perhaps a little bit longer. And the reason for that is that our small cap focus has started re-rating as investors are gradually shifting towards the smaller cap segment. Some of the holdings you see at the top, particularly the top three, have become disproportionately large because of relative outperformance. They have been so successful in developing their business and attracting investors' interest that have outperformed the portfolio. And in some cases, these percentages are after some profit taking that we have taking advantage of some price spikes. But generally, we allocate a high conviction portfolio, approximately 4% per company holding. It's a global diversification with approximately 40% exposure to the North American space, another 25% to the Australian and Far East basins, and the rest Latin America and Europe. So if I take a couple of minutes to tell you the highlights of our three top holdings to give you a feel of why these companies have been so successful in a very downbeat and bearish market to attract investors' interest. Questerre Energy is currently has approximately 310 million market cap, of which 30 million is net cash. And the key to its story is that it controls the largest land position in the Utica Shale in Quebec, in Canada. Together with Repsol, the Spanish multinational, with Questerre controlling 25%. And this is considered to be one of the most economic plays in North America. The catch has been that the Quebec government had banned hydrocarbons well fracking for over 7 years. And Questerre has been fighting to pass through the local awareness and liaise with non-governmental organizations and local authorities to accept that fracking is not a dangerous business, it's not going to pollute the water table, and it's not going to cause environmental damage. So ultimately, a year ago, the Quebec government approved the necessary legislation to allow hydrocarbon fracking, and that was the catalyst for propelling Questerre to re-rate and capture the potential value of its economic play. The company is still awaiting for the detailed fracking legislation, which is being published gradually before it can start drilling and testing of its plays. But according to some independent assessments, each share, each 25% share in the play could contain approximately 1 billion barrels of oil. So you can do the mathematics and see what could be the implied valuation for this company, particularly given that Quebec imports almost all of its gas needs from elsewhere in Canada, and the pricing in Quebec is slightly higher, i.e. more advantageous than the rest of Canada. But in addition to that, whilst waiting for this legislation to pass through and to start the testing of its drilling, the company is very busy developing a monthly play in Alberta, which is very prospective. It's a condensate-rich natural gas play that provides good cash flow and sustainability of operations. And this is exactly what we are looking for in a company. We want to have sustainability of operations under any price environment, certainly without undue reliance on the capital markets, because one never knows when the window might open and close for financing. And finally, they have secured a very large oil shale resource project in Jordan, which is still a very early stage play, but it could contain 7.8 billion barrels of oil. The next of our largest holdings is a company called Carnarvon Petroleum that controls two very large discoveries in the northwest Australia. It's only capitalized at about 100 million Australian, of which 53 million is cash, without any debt. And the jewel in its crown at the moment, it's a field that it acquired in 2016 for BHP Billiton called the Buffalo Field. And that's a redevelopment project. The field produced approximately 20 million barrels in 5 years, from 1999 to 2004, when Billiton decided to abandon it. And if you can recall, in 2004, oil prices ranged between $35 and $50 a barrel. So with an average of $38 to $40 a barrel, the project was deemed uneconomic. But at the time, they did not have the benefit of modern technology that could assess the stratigraphy and the geology of the play and how much more oil could be extracted with modern methods. So the company estimates that with a development cost of less than $5 per barrel, there could be another 31 million barrels of 2C reserves with a potential revenue of $1.5 billion at current prices. So it's a very, very prospective company for such a small company, which they could farm out and get a much larger partner to pay for the development costs. And that is the premise of a company like Carnarvon. They are early stage developers. They identify the license areas that are prospective. They engage technical specialists to conduct seismic surveys and interpretation, and then find larger industry partners to finance the development cost. In addition to that, the company has discovered a very large gas field, again in northwest Australia, called the Phoenix Project, in partnership with a local private equity operator called Quadrant Energy, which after a 4-well, all-successful drilling campaign, targets 1.4 TCF and 108 million barrels of oil, which could potentially supply 20% of Western Australian gas needs. But of course, Carnarvon is not going to stay around and raise the financing for the development of our field. They would probably look to sell it on to some other partner. And in addition to that, they have some other earlier stage projects that could develop into a pipeline as they move forward. And finally, the third of our largest holdings is a company called FAR Limited, which is an Australian-listed company with market cap of 370 million and cash, of which cash 91 million. but it's focused in West Africa, beg your pardon, particularly offshore Senegal, where it has made 2 world-class discoveries in 2014 in partnership with Cairn Energy and ConocoPhillips. FAR holds a now participating 15% interest. Initially, it was carried through the drilling of those wells. And again, this is the advantage of these early-stage mover companies, where they can identify the prospect and then attract a large industry player to come in and finance the development. But this project is now advancing very rapidly to production and commercialization, with first production expected in 2021, with also the potential that reserves will be increased along the way. And latest news is that the company has secured a strategic alliance with the Chinese national oil company covering offshore Senegal and the Gambia, which is the particular area of expertise of the management team. And in addition to that, they have some other licenses with exploration potential in Guinea-Bissau, the Gambia, and Kenya. So it's a proven early-stage developer and explorer that is likely to attract farm-in deals. And that's the type of company that we like in the present environment, that commands significant discovered and identified resources that could be assessed with a material valuation much higher than the market capitalization, but also has the capacity to bring forward new exploration plays and new partners to finance the development. So with that, I would like to wish you happy investing, and thank you for listening. And if you have any questions, I'll be happy to answer.
Do you have any questions for Angelos?
Okay.
No one? Post lunch?
Happy listeners.